Wonderful. Thank you so much for that. Good afternoon, everybody, and welcome back. My name is Agnes Watson from Stock Perks, where we're reimagining how companies engage with their individual investors and work with companies to make sure individual investors feel like real owners. You should check out our app. Just a quick reminder to submit any questions you may have. We'll do our very best to answer them. Right now, I am absolutely thrilled to be speaking with Blake Fernandez and Uzi Yemen of Delek US Holdings. Blake runs the investor relations team and Uzi runs the company as Delek's CEO. I know Delek US Holdings is very passionate about individual investors and they even offer perks if you're a shareholder. Gentlemen, absolutely wonderful to be speaking with you. I'd love to start off by having you tell us a little bit about Delek.
Well, good afternoon. Thanks for having us, Agnes. It's a privilege to be here, and obviously having you hosting us is a great event for us, which we are very excited about. A few words about Delek US Holdings. We're a downstream company established 20 years ago, grew through acquisitions and organic growth, which our business model is a little different than most companies in our, or most of our peers, as we are trying to be integrated, which means we take the oil from the wellhead. Obviously, we're not upstream, so we are not looking for oil. We're not searching for oil, and we're not producing oil. We just get it from the wellhead, then either by trucks or by pipelines. We take them to a gathering hub, if you will. From that hub, we take it to our refineries or other refineries. And from our refineries or other refineries, they start producing what we use as gasoline, distillate, jet fuel, and other products. From there, through our pipelines or other pipelines, we move these barrels to our stores or to the customers or to the terminals. And then at our gas stations and convenience stores, we sell coffee. So it's an integrated chain all along. We're using only American oil, domestic oil. We used to, in the past, before the revolution, the energy revolution in the United States, to buy foreign oil. But since then, we put all our eggs in the American basket. So we are using only American oil, and that serves not only our refineries, but our midstream. We look at our business as three segments. The first one is the logistics, either gather crude oil, move products through pipelines, through terminals. The second part is refining. We have 4 refineries, all in niche markets. And then the last one is retail. Obviously, over the last 2-3 years, ESG became a very strong initiative or component of our business. What we actually do is we try to minimize our impact on the environment. Actually, if you look at the Sullivan study, which is the way our industry looks at our benchmark, where our refinery is in the top tier of maintaining good, clean carbon emission, if you will. That's something that we pay attention. We talk about every day. And at the same time, we continue to believe in American energy. We do have renewable diesel plants, and we do use ethanol. Of course, through our logistics, we are providing a tremendous amount of opportunities to other people when they produce to come to our facilities. I must admit that if we look at DKL, which is the logistics arm of DK, we perform very, very well. It's mainly retail. People like you that are buying into the company. The market cap is close to $2 billion, and it's performing very well with the return of or yield of 8.5%. Over the last 9 years, every quarter we increase our distribution, and there's no reason to believe that we won't continue to do it over the next year. That's the outlook that we're giving. We are very proud of how we manage the distribution of the logistic arm, and then or logistics arm, and obviously retail. This is not embedded in our valuation. retail is performing. Retail is having the best year ever. And if you look at multiples in our industry about retail, we're talking about 11, 12 times. And if you look at what Delek is traded at, retail is maybe 5 times. Eventually that will change. We're in the business of building stores. We have organic growth, and we're building stores, and we'll talk about them, I'm sure, as part of your questions. Speaking about the integrated mall, more than anything, it's important to us that we participate in each part of the value chain. If it's crude oil, if it's pipelines, refining, product pipelines, product terminals, as well as convenience stores. So some people say that we have a business model that has different components. We look at it as almost between the wellhead to the coffee to the driver, all the way down the chain. Anything else, Blake, you think I should add to, or you want to add anything to that?
No, I think it's a pretty good recap, Agnes. Just to remind you or investors, DK owns 80% of DKL. So we do have 2 publicly traded companies. DKL is what Uzi mentioned, where the yield is extremely attractive, 8.5%. We've increased the distribution, like he said, over 30 quarters in a row. So good consistency there. And I think in this environment where investors are looking for yield, it's certainly something to take a look at. And then at the Delek level, we continue to transition with the global energy transition. So we're a refining company today. We have an option to participate in renewable diesel, and we're constantly exploring other options like hydrogen council, carbon capture, these type of things. So we want to participate in the ultimate energy transition. So I think with that, we've covered a lot of ground.
Love that, ultimate energy transition. Just quickly, I know the last 18 months have been very interesting with regards to pandemic and everything that's been going on. How is product demand evolving as we start finally coming out of the pandemic?
First, it's hard to measure it on a daily basis, but I'm going to say with confidence that the American people are hitting the road. And I think we all saw last week the numbers coming from the agencies. The agencies measure the product demand on a weekly basis. And last week was a record week since 1990. So we broke a record of 30 years last week. Now, as we feel more and more comfortable, and I've seen it in Israel, we all hear my accent. Of course, I'm an Israeli. In Israel, the demand, as people started to hit the roads, the demand is 110% compared to what it used to be pre-pandemic. So we are not seeing the 110% just yet, but refineries are running full wide open, still we had a big draw of gasoline last week. We'll see what will happen over the next few weeks, but if the vaccination will continue the way it is, we believe that demand will be very strong. I do believe that 2022 will be probably the strongest year ever in terms of demand, just because of the fact that many CEOs want their employees to come back. I read a survey that 80% of the CEOs want their employees back in the office, together with the fact that people were sitting at home for a long time and they want to travel. I expect 2022 to be a very strong year in terms of demand.
Yeah.
Blake, do you want to add anything to that?
The only thing I would add, Agnes, I'm sure you know this, but the vaccination uptake, as it progresses, I think it's really going to help the jet demand on a global basis, because we haven't really seen that international travel pick up quite as much. And I do think, like Uzi said, as that happens into next year, that's really going to help the full downstream complex as far as the margins recovering. So we are quite optimistic moving into next year. I do think our company is more of a kind of a play on post-pandemic recovery. So
yeah, I think that's fantastic, and I agree. I think people wanting to go back out there, they want to travel, they want to see people, they want to get back out. So spot on what you're saying. Can we chat a little bit about growth and opportunities where you see for the business to grow going forward?
Well, of course, I'll cover part of it, and I'm sure Blake will cover some of it. We are in the middle of energy transition. Now, who knows what energy transition means? We are trying to guess it, but we want to be smart. So while in the past, during downturns like that, we were jumping to make an acquisition. This time, we want to sit and see what's going on with the energy transition and carbon capture. We are looking at ourselves technologies for carbon capture or making our products cleaner. If the trend of EV or renewables will continue, and right now renewables is a great hype, but it doesn't make much money without government subsidies. For example, our biodiesel plants without the government subsidies won't make money. So long term, you want to make sure that you get a healthy business without government subsidies. So what we're doing right now, we're watching the market very carefully, learning a lot, absorbing, and see what we need to do before we jump into the pond. With that being said, on the logistics side, we'll continue to look at inorganic growth, and of course, on the retail side, we'll continue to build the NTIs, the new to industry stores. These are big stores that the return on them is between 20 to 25%. Blake, anything you think I missed?
No, you covered it. I think Agnes, we've done a good job of lowering our cost and lowering our spending to adjust to the macro environment, and we're going to be very selective and prudent going forward in terms of reinvesting. So we're going to evaluate the best opportunities going forward, but we've definitely lowered our overall profile from a cash flow break even.
Very good. You mentioned energy transition, and you also mentioned when your opening speech something about renewable diesel option. Can you tell me a bit more about the renewable diesel options that you have?
Do you want to cover that?
Sure. So we sold the Bakersfield refinery to Global Clean Energy last year. And as part of that sale, what we did is retained an option to participate in a 33% interest in the facility once it's operational. It's scheduled to come online at the beginning of next year, and we have a 90-day free look to take a look. We've disclosed the amount, which is only $13 million to exercise that option. And so most would agree that's a fairly de minimis amount of money. And renewable diesel has really been the new hype within the industry. Most refiners are getting into the space. The good thing about Bakersfield, it sits right in California, which is part of the LCFS program. So in other words, it really improves the economics because you don't have to transport the product to California to get that credit. It's sitting right there. So it is one of the larger facilities coming online, and people are fairly optimistic. It also has a unique aspect in that it's going to run what they call camelina oil instead of your traditional soybean. So it's a little bit differentiated in terms of feedstock, and they're growing their own feedstock, which should kind of mitigate some of the risks of escalating feedstock for soybean and some of the other typical feed that other refiners are going through. So I think a lot of people view this as a really exciting option, but the good thing for us is it doesn't require a lot of capital. So it's a way for us to participate in that transition without spending a whole lot of money.
I'd like to say something about renewable diesel in general. We have biodiesel and renewable diesel. We've been in this business for years. The idea of driving food can be scary. And you see the price of corn, you see the price of soybeans, and we just need to be careful not to get too excited about this renewable diesel as a country. I don't think that we have enough land or enough core to justify a renewable diesel the way people think about that. We just need to temper our enthusiasm, if you will, and to make sure that we're not jumping into something that doesn't make sense. Because driving food can be very risky.
Yeah, that's fair. More of an individual investor question. I know you guys used to pay dividends and you suspended them during the pandemic, as well as share buybacks. Do you see that returning, and if so, when?
Absolutely. Our goal is to make sure that Unlike many other growth companies that don't care about their free cash flow, we do care about our free cash flow. That's how we think about that. We think, hey, if we pay dividend or if we buy shares, it should come out of earnings and out of free cash flow and not out of borrowing. We're very comfortable. We have $800 million on the balance sheet. The moment we start showing positive free cash flow, which I expect with the demand coming back in the next few quarters, I don't see any reason why we won't look at the dividend as well as other means to return cash to shareholders.
And I would just remind you, Agnes, too, getting back to that previous conversation of DK versus DKL, the dividends were suspended at DK, but of course DKL has had that long history, so we are still maintaining the dividend there and continue to increase it.
And we are very proud with that, increasing it every quarter. So 8.5%, we feel good about ourselves.
Yeah. One more question. You mentioned you guys have been around for 20 years. You've grown through acquisition and organic growth. You have a number of different business segments. Are you active in M&A? Can you talk about the M&A opportunities out there, what you're doing?
You broke up just a little. I think the question was, are we active with M&A? Do we look at anything actively vis-a-vis inorganic growth? Was that the question?
I think it was, Uzi. It looks like Agnes is frozen.
Okay, I'll take it assuming that this was the question. So obviously, for years, we're looking at M&A, and for years, we're active in this market. In order to be in that market, valuation needs to be right. And also, it needs to fit our long-term strategy. And as I mentioned, the situation today in the marketplace with the energy transition is that we want to make sure that we are not buying the past, but buying the future. So we are in the mode of looking at different things, but we want to be very prudent and to make sure that we're not making any mistakes in buying something that belongs to the past, which did great in the past, but doesn't fit the energy transition, if there is energy transition. And I'm not sure what energy transition looks like. Is it carbon emission capturing? Is it wind? Is it solar? Is it other means? I don't know. I don't know, Blake, if you want to add anything.
No, I think that covers it.
Perfect. If you don't mind, there's a couple of questions that have come in from the audience. One of them is about retail. You mentioned retail stores. Could you tell me a bit more about your retail growth and what you're planning to do in that area?
Yeah,
take that one.
So Uzi mentioned earlier, we're seeing some of the best return opportunities in retail. We see about a 20 to 25% rate of return on those, on the build out of those new stores to industry. The good thing, Agnes, is you can spend about $4 or $5 million to build a store. And within energy, that's a fairly small, short, ratable kind of investment compared to big, refineries or pipelines or those type of long lead projects that are very capital intensive. So I think we can progressively ramp up the growth in retail and match it with the free cash generation of the company and provide a really nice rate of return. At some point, if the market is such that we can divest and get a really attractive valuation multiple, I think we would always consider that because we don't have any sacred cows. We've actually sold retail in the past. The MAPCO entity was sold. But for the time being, like I say, within energy, we really see some strong opportunities to build out the retail. The new stores to industry are a little bit bigger footprint, nice, unique food offering. And as Uzi says, people eat with their eyes. So a nice, clean, brand new store is really attractive. And not only do we see nice margins on the fuel, but also the in-store margins as well. So,
and I want to add something to retail. This company, Delek, started as a retail company. So we have our roots in retail. We are not shy of selling retail if we see the value there. But we actually know how to run retail. And if you look at what happened when we bought these convenience stores, the EBITDA used to be $25 million. We are on track to more than double that within 3 years.
Oh, wow. Great. One more question's coming. Can you tell us about the impact of RINs on Delek costs so far this year and throughout the rest of the year?
Yeah, so, Agnes, we don't disclose what our actual RIN exposure is. We do have blending capability, and that's part of the benefits of being fully integrated, like Uzi said, being from the wellhead all the way down through the retail stations. So, I don't want to mislead you. There's no doubt with the RIN price where it is today, we feel that the system is broken, and it's a real overhang on the industry, including us. But relative to other refiners, we do have the ability to blend and generate some RINs and mitigate our exposure to a certain extent. I would just remind you too, historically, even under the Obama administration, small refinery exemptions were granted by the EPA. There was just, the Supreme Court just ruled in favor of refiners just recently here, and it remains to be seen, but we're actively attempting to get small refinery exemptions for specifically El Dorado and Kratz, who were continuously receiving these even under the Obama administration. So to the extent we get those exemptions, that would go a long way in alleviating our obligation for RINs.
And I want to say something about RINs as well. The Supreme Court has just decided 10 days ago that EPA cannot grant these exemptions or these waivers is not correct. It just happened 10 days ago. So that opened the door for companies like us that got these waivers in the past to apply for them. And we're going to be very aggressive in seeking for these exemptions. And past experience shows that we were successful being granted these exemptions. So don't be surprised if you will see that coming our way.
Okay, good. One more question has come in around energy in general. It says energy has traditionally underperformed in broader markets until recently. How do you think investors are positioned going forward?
Well, markets come and markets go, and energy underperformed the market in general for a reason. When you have 40% of your demand going out of the window overnight, but at the same time, the world still sells 120, 130 million cars every year. We still have 1.2, 1.3 billion cars around the world. Still, EV is a fraction of what is being sold. I think that the industry should work very hard for this carbon capture. But when you go to a movie, or when you go to work, or when you fly to meet friends or family, you use fossil fuels, and that won't change over the next 2, 3, 10 years. Won't happen. To undo the system will take years. It doesn't mean that we as an industry don't need to invest in carbon capturing, in other means of energy. Absolutely. But as we'll get out of the pandemic, energy is, in my mind, one person's opinion, is the place to invest.
Yeah, I was an energy investment banker, so I'm all for it. I get excited about it. Gentlemen, it was so absolutely wonderful speaking with you both. I'm excited about Delek's future. I'm excited what you're doing. I'm excited about the transition paths that you have. Is there any kind of last final words you want to share with retail investors that get really excited and passionate about the companies they invest in, and invest in you, the management team, as well as the company name and the performance, but they're really investing in you? Well, and we don't take it lightly. Yeah. We really take tremendous amount of pride. And in your opening comments, you mentioned the passion that we're using here, not only vis-a-vis investors, but running our business in general. So we thank you for taking the time, and hope to talk to you soon and to deliver on our promises. Thank you. Yeah, I want to hear an update for sure. Gentlemen, thank you so much. It was absolutely delightful speaking with you both. Thank you. Thank you. Thank you so much. Thank you. See ya.